Good evening once again, everyone, and welcome to our live practice session 6 for SBR September 2026 attempt. We have already finished 5 live practice sessions. Today is the fifth one. Sorry, today is the sixth one. We'll have one more regular practice session, a seventh one that will be coming, and the schedule of that will be also shared soon, but that's not a regular session in the sense that mostly it wouldn't be on a weekend, it would be on a weekday only because this is like an extra session that we plan. And during the revision week, between because the revisions are going to be held on the weekend, y'all will have grand revision, y'all will have grand webinars. Because they're going to be longer, we will require weekends for them. So our live practice session 7 will be in between. It will not be on the weekend. Okay. However, the timing for all these sessions will be shared with you all in like one planner, so that you all can, take the leave accordingly from the workplace. Okay. Now, moving ahead with today's session. So, I had told you all last time also that there is something that I wanted to cover from financial instruments aspect. Financial instruments, what you see in the pre-recordings is heavily IFRS 9. Okay. The measurement of financial instruments. If it's a financial asset, what do you do? If it's a financial liability, what do you? If it's a financial asset, debt element or debt instrument or equity instrument, depending upon that. And then further, what is the intent? Whether it's short term, long term, whether it's hold till maturity or may sell in between. So depending upon so many classifications, the accounting treatment takes place initially, subsequently, right? All that was taught in IFRS 9, and what you see in my pre-recording is around that. In SBR also, what we introduced was impairment of financial instruments. That is also a IFRS 9 topic. What today I'm going to cover in financial instruments specifically is your IAS 32 presentation of financial instruments. Normally, this could be a very easily neglected topic because you would think that this is a lot to do with the discursive, and you wouldn't anticipate SBR exam style questions on IAS 30. You wouldn't have anticipated. But they have, managed to even test from here in the past in the December 2025 paper. In fact, we've cracked Carroll Company in the practice session 5, where we catered the IFRS 18 element of it. We catered the IFRS 18 element of it, and the other element was on IAS 32 presentation of financial instruments. So we're going to cater that second element, requirement A, today, and we're going to also cater requirement B on KPIs today, because as per the planner, by now you all should have watched KPIs. Just in case anyone has not watched KPIs, it's okay. If anyone has not watched KPIs, it's okay. It's not something that you will not be able to follow. This is very logical. KPI as a concept is very logical. So whenever a question practice is done on it, you will definitely understand it. Okay. As far as IAS 32 is concerned, definitely if you have watched IFRS 9 financial instruments, my pre-recorded lectures, you'll be able to follow most of it, because what I'm going to do today is IAS 32 presentation, yes. For the presentation part, purely the presentation part, which is highly discursive, maybe any pre-understanding is not required to that extent. But what, like I said, I'm going to discuss an exam, real past exam question also. There I'm going to dive into numbers as well. It's going to be IS 32, and then it's going to be numbers as well. So if you have not done your if you have not done your IFRS 9 financial instrument from the pre-recorded, the Carroll Company, you will not be able to follow much. Okay, you'll not be able to follow much till the identification part. Yes, you'll be able to follow. After that, you will not be able to follow. My advice, if you have not watched IFRS 9, still stick through this session. There's definitely something that you'll be able to take away. Okay. Again, when you're done with IFRS 9, you can come and revisit the question practice part, Carroll Company again. All right. So I'm going to now share the screen. I'm going to bring it on the past practice question. Just one question, guys. Any of y'all have been able to access the ACC Study Hub in past 2 days? Because I've been trying and it's not working. So I just want to know, it's a error in my ID, or everyone universally globally is facing the same issue? anyone in the class who was able to open the ACCA Study Hub? Right now, I can clearly see there is a change that first for Study Hub, you had to go through the Study Hub link. Now it's in your My ACCA login. From there, you have to go to My Qualifications. But once you go into My Qualifications and you get into that, your in progress courses, are you able to access? Okay, you're able to access. Then I have some issue. Okay, I'll contact them. No problem. I'll share my screen. So what I'm trying to say is, if you go to your study hub here, okay, get it. It's going to ask me to log in to the entire thing, so I'll avoid that, no problem. Anyway, coming back to our September-December 2025 question. I have already uploaded all the past paper questions in your portal, Wifi portal. If you will go, you will see a past paper section and all question papers have been uploaded with the answer, solution of ACCA. Even for many of the papers, I have already provided my solutions as well. Okay, my solution has also been provided. So you can go and check the past papers. This PDF is available for everyone. So coming to Carol Company, I'll read the background, then the requirement that we are going to crack. Okay, sorry. Before I go to Carol, the number crunching, you all will get it definitely very easily because it's a follow-on of IFRS 9. But before that, I want to get into the presentation because it has presentation elements. Okay. Okay. So now coming to IAS 32, presentation of financial instruments. Now, IAS 32, presentation of financial instruments. Starting, I will throw light on what is a financial liability, what is a financial asset, and what is an equity instrument. I know that in my pre-recording, this is something that you'll have already gone through, but again, a revision is required. Okay. What is a financial liability? It's a contractual obligation. A contractual obligation meaning you have entered into a contract, and as per the contract, there is an obligation on you to deliver what? To deliver cash or other financial asset to another entity. This is the main sentence here. This is the main sentence. If anyone has memory issue, memory is weak, cannot remember a lot, then this is the sentence that you have to remember for financial liability. It's a contractual obligation to deliver cash or another financial asset to another entity. Okay. So just remember, if I have to shrink it, obligation, obligation to deliver, or I will not miss the contractual word, contractual obligation to deliver cash or another financial asset. Just this much. A shrink version. Okay. The second point is to exchange financial assets or financial liabilities under potentially unfavorable conditions. So yes, this is also financial liability, but for once, I will not put pressure on remembering this. If you can't remember a lot, it's okay to not remember the second point. But first point is very crucial. Okay. Second point, what does it mean? You all know that when you enter into derivative contracts, there'll be sometime contract where you probably have entered into which would be a loss making contract, meaning you have to buy, let's say, certain inventory items at a future date at a fixed price. Let's say you have to buy it at $2, but market price is going to be $1.5 in the future. Then that's unfavorable condition. That's an unfavorable condition for you, that you have locked a higher price to purchase while market price could be lower. So that's an unfavorable. So that would become a financial liability in that sense, to that extent, the loss part of it. Okay. So anyway, I don't want to complicate things for you. Like I said, that you all will have to remember the first sentence clearly. That's important. A contractual obligation to deliver cash or another financial asset. That's it. Just very few keywords. Contractual obligation to deliver cash, to deliver financial asset. Now, similarly for financial asset, it's a contractual right. It's a contractual right to receive an equity instrument of another entity, a contractual right to receive cash or another financial asset. So again, these two are very important. That is a contractual right to receive what? An equity instrument, cash, or another financial asset. Equity instrument, cash, or another financial asset. Okay. The third thing, again, if you want to, let's say, for example, not remember a lot of stuff, If it's unnecessarily going to confuse you, then you can skip the third point, but not skip the first two. The first two are very crucial. Okay. The third point is a contractual right to exchange financial assets or liabilities on favorable terms. Same example that I gave earlier, that you have locked a price to buy a certain item. I have locked it at $1.5. In the future, the market price for that is, let's say, $2. So you are going to pay a price lesser for something which is worth more. So that's a favorable term for you. That's a favorable. So that's a financial asset. Okay. Anyway, again, just a quick revision. Financial liability, contractual obligation to pay cash or give another financial asset. Okay. For financial asset, contractual right to receive cash, equity instrument, or another financial asset. It's very simple, actually. Okay. Next, equity instruments. So what are equity instruments? You all know that if you take up all your assets and remove all your liabilities, what remains is the equity. So that itself is just being defined in one line. The residual interest. Residual means what? It it is probably something sounds like a technical jargon, but residual means nothing but remaining. Okay, residual means remaining. You all know when you say, you drank water and the residue remains at the bottom, because if you drank something with flavor, the particles will remain at the bottom. Residual, whatever remains at the bottom, right? So residual is remaining. So residual interest in the assets of an entity after deducting all its liability, or you can say whatever remains. Even you want, you can further simplify. Whatever remains in the entity after deducting all the liabilities from its assets. It's okay. You can also describe it in your own words. It should mean the same. It should mean the same. Okay. So moving ahead from here now. Now, what will happen? Okay. Now, how is the real world complicated and how is this SBR making things complicated for you? In the real world, the in a way that it has to be returned to a shareholders, yes. But that's a very generic way to understand that, yeah, something needs to be returned to the shareholder. If you go from a bookish description and from the way how accounting has to happen, then they are very different, right? From an accounting perspective, they are very different. But conceptually, if you have to understand, okay, this also has to be returned by the organization to someone else, to that extent, yes. Now, when we are talking about segregating, accounting, identifying that point of time, don't consider them same. Okay. Why? Because we're specifically discussing the differences in these. That what would be equity, what would be liability, why are they different? At the end, they're not same, right? They're different, no? Because otherwise, why are they being in two different sections, right? Why is something called liability and why is something called equity, right? I know I say equity is like liability because it needs to be returned to the shareholders, but there is a difference as why they are differently categorized. So we're talking about the differences today, okay? Anyway, like I said, why is SBR difficult? Why is the real world difficult? How are they making things complicated for you? Okay. So understand that in the real world and in the SBR, you will be given scenarios where it will not be easy for you all to look at just the statement and identify, oh, is this a financial liability or is this a financial equity? Okay. You will not be able to easily identify. Why? Because for liability, what it is, okay, uh, for liability, it is an obligation to pay cash or another financial asset. Equity is the residual interest. The way the scenario will be painted, it will have little bit mix of elements, okay, and it will become very confusing to identify. So in detail, we are going to discuss these complexities, that when you see a complex scenario, how do you clear cut make a distinction that no, this is a financial asset, sorry, this is a financial liability instrument and this is an equity instrument. How do you make that clear cut distinction? Okay. So let's start. Now, here I'm doing the liability and equity segregation for preference shares. I'm going to get into the details for preference shares, assuming that when the redemption of the preference share will happen, or when the payment against the preference share will happen, it will happen in cash and it will happen in cash. Okay. It will happen in cash. Okay. Now, understand that there'll always be an entity which is going to issue and then there'll be an entity which will be the holder entity. Who's the issuing entity? The entity which is going to issue preference shares is the entity which is going to borrow money or is going to be the lender. Can you all put in the chat box? The entity who will issue the preference shares, is it going to be the entity which is going to borrow money or is it going to be the entity which lends money? Yes. This is the entity. The entity which issues preference shares is the one who needs money. Is the one who needs money. So this is the entity which is going to end up borrowing money. Okay. And the holder who holds or who owns those preference shares, either soft copy format or the physical format, those holders are going to be the lender, are going to be the lender. So for them, it's an investment. So for these lenders, it's like an investment. For the borrowers, it's a liability. Okay, it's a liability. Now, let's get into the classification of it. Now, preference share. Okay, so it's the word if you see is share. So when you read the word preference share, you will be like, oh, you know what? It's an equity instrument. What you are giving is a share. So it's an equity instrument. The way it needs to be treated is when you issue the shares, share capital, share premium needs to be hit. Equity should increase. This is a very simple, clear cut, on the face of it understanding, right? But like I said, real world and SBR both are difficult. So even if the word is preference share, you will have to look at its features, read the features in details. If it's a redeemable preference share at holder's option, redeemable meaning you definitely have to pay back. There is a redemption date that after 5 years, this is payable. After 5 years, this is payable. Okay. So if it is redeemable at the holder's option, okay, which means the holder, who's the lender, can demand money, then it's a liability, because from whomsoever you have borrowed money, you can demand that money. So it's a liability. Okay, because you have an obligation to pay cash. What did the definition say for financial liabilities? That it's an obligation to pay cash. So the reasons also I've given you very clearly in the third column, that here, if it is redeemable at the holder's option, then there is an obligation to pay cash. Okay. I hope till here everyone is clear. Now coming to the second scenario, redeemable at issuer's option. Here the issuer party is the party who has borrowed money. Just one second, please. Okay, back. Now, redeemable at issuer's option. Now, redeemable at issuer's option meaning this is the party who has borrowed money and it is at issuer's option to return the money. It is at his option. Till then, he can end up probably paying interest. Okay, so it is in his hands. If that is the case, if that's the case, then this is an equity. Then this is an equity because there is no obligation to pay cash. Because there is no obligation to pay cash. That's missing, no? There's no other party which is going to be like, you know what, you have to pay me now the money. There is no party which has that kind of right on you. You have that option to when you want to return it. So it is like equity, because what happens in equity? Till you don't want to buy back those shares, till you don't do the winding up of the company, there is nothing that is an obligation towards those shares, right? So this is redeemable at issuer's options. This is why it's like an equity, not like a liability. Okay. So that's why I said, look, it's so confusing because the word is share, but treatment can be liability if there is an obligation to pay cash. Why? Because that's holder's option. The treatment can be equity even though it's redeemable, because the right is with the issuer. Okay. So go slow. If you understood, but there is still partially a gap, just go slow again, because the answer is in the terms here. The answer is in the terms that why are we doing this certain treatment? Okay, why are we doing this certain treatment? Now, the third case, that these are irredeemable. These are irredeemable shares, which means there is no obligation to pay them after a certain period of time at all. They are not redeemable. If they are irredeemable, then for us, they definitely act like shares. So it should have been equity. It should have been equity. I'll come to again the previous one. Okay, first, before I go to the next two, and all those who want me to repeat the redeemable ones again, Let me know in the chat box. Who all wants me to repeat? Who all wants me to repeat? Okay, I'll go through it again. Don't worry. Okay, I'll go through it again. Redeemable shares, redeemable preference shares, okay, depending upon who has the right to demand for money, or who has the right to make that call of payment, the treatment will depend. So redeemable preference shares, you know that, okay, after a certain period, ideally the concept is that it has to be paid off. But if it's a redeemable preference share where the holder, you can see at the right, who's the holder? The lending party. The lending party is the holder. If he can demand the money, if there is a clause like that, that he can demand, it's at his option, then this is an obligation to pay cash. So treatment is like a liability. Treatment is liability. This everyone understood, that because lender can demand cash, there is an obligation to pay cash. Because lender can demand cash, there is an obligation to pay cash. This everyone understood? That there is an obligation because the lender can demand payment. Okay, so that's why it's a liability. No debates here. The second case, it's written in the scenario, these are redeemable shares. Okay, so you'll be like, oh, redeemable shares, let me give the treatment of liability. No, it's written those are redeemable shares, but along with that, it's written redeemable at issuer's option. The party who borrowed money, he has the right of when to make the payment, which means the holder has no right to demand payment. Holder has no right to demand payment. It is with issuer when he wants to make the payment. Okay. If that is the clause attached, then there is no obligation to pay cash. In a way, it is like if holder has the option to pay cash, right? If holder has the option to demand money, that kind of obligation is missing. He has to pay, but it is at his option. So if that is the case, then this is like an equity. This is like an equity, because what happens in equity? There in equity also, it's not completely that there is no obligation to pay cash. There is, but when on winding up of the company, not that okay, after 5 years, 6 years, there is a compulsion to pay money, right? So here also, if issuer wants, he can make a payment after 5 years, he can make a payment after 10 years, or he could actually do it on the winding up of the company also. He has the right. He has the right. At the end of the at end winding up, definitely he'll have to make a payment. So there is a payment that he'll have to make, but that's at winding up. And at winding up, which is the category where on winding up it becomes an obligation to make a payment? That's an equity category, no? That's an equity category that on winding up you have to pay. So yes, this is then your equity category. So did you all understand the redeemable concept, liability and equity? Okay, great. Now going to the irredeemable one. Now, irredeemable, with the name, what we will think, okay, they are not going to be redeemed at all. Again, only on winding up of the company, because someone has invested in your organization. Of course, there is a interest in the organization recorded by the opposite entity who has invested. Definitely, this has to be paid, but it's not redeemable. It's irredeemable. So again, maybe on the winding up of the company, it has to be paid. So you will think, okay, in both in either cases, it's irredeemable. You'll see the word irredeemable. You'll say do equity treatment, right? Sounds correct. And in fact, it could be right. But if there is an additional clause attached with the irredeemable, that there are mandatory dividends. If irredeemable preference shares has mandatory dividend payments, then don't you think obligation to pay cash has arisen? Yes or no? Don't you think an obligation to pay cash has arisen? Yes or no? Yes. So in that case, it becomes a liability. It becomes a liability. Okay. Now, the last category here, irredeemable. Again, I don't have to pay for this borrowed funds uh, till winding up only, of course. And along with that, additional clauses attached of discretionary dividend, meaning I can pay, But this is management's decision. Okay. Whenever management wants to pay, they will pay. There is no compulsion, no mandatory dividend. Okay. So if there is no mandatory dividend, you're not going to redeem. Sorry, you're not going to pay back for the investment if they are irredeemable. So mostly it would be on the winding up of the company. What is the nature then? There is no obligation to pay cash actually. It's all on the decision basis. So this is equity. This is equity. Okay. So if you go slow with an open mind, on the face of it, redeemable will be like it's a liability, and irredeemable share is equity. But again, in both the categories, you have to read each and every clause and terms. The clause and terms within that, the additional ones, will still make a difference. You can't have a default approach, they'll still make a difference. Okay. Now, I'm going to read this example. I don't want you all to read the solution at all. Just focus on the example that's here. During 20x form, I want to zoom. Sorry, I'm just trying to do something. I'm trying to zoom. Yeah. Yeah. During 20x forms, Starling issued 5 million irredeemable preference shares. When you read the word irredeemable and you read shares, you'll be like, oh, you know what? They are irredeemable preference shares. They will be equity. Okay. But no, you'll read all the clauses. Okay. So during 20x4, Starling issued 5 million irredeemable preference shares in order to raise funds to pursue a new strategy. The shares pay a mandatory cumulative dividend at 4%. Just these two sentences. Quickly give me in the chat box, is this liability or is this equity? There are terms in this which will clearly tell you is it liability or it's equity. Okay, so till now everyone is telling me liability, nobody's telling me equity. So great that everyone is in consensus here and there's no confusion at all. But tell me the reason why. Why you all said that it's a liability? What is that one term which makes you all say that this is a liability? One term. Just one term in this question.
I have one doubt.
Mandatory. Is someone trying to say something?
Ma'am, I have one doubt regarding this particular circumstance.
Yeah, just 1 second, Raghavina. Okay, once I'm done with the scenario, I will come to your doubt. Don't worry. Okay, perfect. So everyone is absolutely correct that it is actually the word mandatory dividend payment which is making us mandatory dividend payment, which is making us come to this conclusion that this is liability instrument and not a equity instrument. This is a liability instrument and not an equity instrument. Okay. Yeah, Raghavina, please tell me.
Ma'am, generally, actually, they take preference shares mandatory dividends. Shareholders get mandatory dividends, and they're treated equally to equity shareholders in that case. Why they are classified under liability? That's the question I'm getting raised.
Okay, so you must have learned at FR some default treatments because at that point of time, from an FR syllabus perspective, we didn't want to, from a syllabus perspective, ACC didn't want to complicate things. But in the real world, and SBR will try to replicate the real world scenarios, it's not that if it's preference shares, it will have mandatory dividends only along with it. It's not that. That's not the reality. It will be a mix, okay? It will be preference shares if it's redeemable, if it's irredeemable, it can have mandatory dividend. It can have not a mandatory dividend. It can be a mix of scenarios. So reality is you'll not have just one scenario. You'll have a multiple scenarios, and they'll be mixed. So that's how you'll based on this table explanation, you'll have to be actually be able to identify or crack what type of instrument it is. What you painted is a very specific scenario, right? That A plus B, only two clauses are there, right? What is the clause you can repeat?
Yeah, ma'am, but the thing is, preference shareholders, same as equity shareholders, they also get dividends. I have a doubt then how come equity shareholders who receive dividends will be treated as liability? Then
No. Wait. I think you're confusing something. See, preference shareholders also are paid dividend. Equity shareholders are also paid dividend. You have to read the nature of dividend payment. In preference shares, again, you have to read whether those dividend payments are mandatory, not mandatory. If they're mandatory, meaning compulsory, then they act like loan. In which scenario do you pay mandatory dividends? The
no,
dividend
ma'am.
given.
Generally, they pay dividends. I'm not saying mandatory dividends. Generally, they pay dividends for equity shareholders, right?
Yeah.
I'm uh, I'm asking on that perspective. That's thing.
No, I didn't. For me, the question is not clear, dear. Equity shares, yes, dividends are there and they are not mandatory. That's why they will go in the regular equity share category. Okay.
Ma'am, I have one clarification. Since equity shareholders are not paid mandatory dividends and they're paid at the discretionary side of dividends, so
Correct,
they are
correct.
treated as equity, and
Right.
preference shareholders needs mandatory dividends, so liability arises. That's
Correct.
what really.
Correct. And but you can see over here that if it's discretionary, this is also equity.
Okay, okay,
Can
ma'am.
you see
Understood.
this? Yeah.
Yeah, ma'am. Yes. That's what I got confused with, really.
Mm.
In accounts perspective, we generally treat them as both as shareholders, right? Not as liability debt holders.
No, so
So,
general perspective, that's what I said, right? General perspective you all learn till FR. Okay, SBR
yes,
is diving into more real world scenarios, so not general but very specific. Like literally you're a consultant and you'll be coming across such complex cases where this is not generic. It's a very specific case that okay, it's written irredeemable plus discretionary dividend. Okay, what is the case? It's equity. It's irredeemable, but it's mandatory dividend. Then what is the case? It's liability. Okay.
yes, ma'am. Sorry, ma'am, for the.
No problem. That's fine. It's good that you clear whatever was the doubt for you. Okay.
Yes, ma'am. Thank you.
No problem. Now we're going to go to the next topic here, settlement in own equity shares. Okay. So there are so many times where organizations, instead of making payment in cash for the obligation that they have, they will choose to make payment in their own equity shares. So they will issue shares. They'll issue shares. Okay. Now, here, what does IS 32 tell you? That if you're going to issue shares, which are fixed number of shares, for example, what I'm telling, okay, what I'm saying is if you have made a borrowing of, let's say, 1000, or let's say if you have borrowed $1 million, okay, you all have borrowed $1 million. The organization has borrowed $1 million. Now there are $1 shares in the organization. Okay, $1 shares in the organization. So you are saying that when I have to make a payment towards this liability of 1 million, you are fixing it that I will pay the liability in the form of shares. You're fixing. I will pay the liability in the form of shares. And how many number of shares? I'm fixing the number of shares. Number of shares I'm fixed. And I'm saying those will be 1 million shares. So to repay the liability of $1 million, I will give you 1 million shares. After, let's say this is payable after 2 years. So after 2 years. Now you'll think and tell me that if I fix the number of shares, after 2 years, the market price of this particular share can be anything, can be $5, can be $4, can be $2, can be anything. So does this act, the repayment that I'm trying to do, does this act as an issue of equity instrument or a liability? It could be anything. The market price after 2 years could be $3, $4, $5. Because of this variability, what I am going to record this instrument as, is this going to be for me an equity instrument or liability instrument? If I fix the number of shares, the shares are fixed. It's an equity instrument. Understand? Yes, absolutely right. It's an equity instrument. Okay. It's an equity instrument. I hope you all did not try to see the classification here and try to answer it logically. That yes, it's an equity instrument. Why? Because you're not guaranteeing that 1 million repayment. You're not guaranteeing. The market price for the share could drop also, let's say. It could become 0.5, 0.25 or whatever, right? For you, the obligation is not 1 million payment. For you, the obligation is not 1 million payment. For you, the obligation is 1 million shares to be issued. 1 million shares to be issued. If that is the case, the share price could be 0.25, 10 cents also. You're not then giving actually 1 million. Maybe you're just then giving $10,000 after 2 years, 5 years. In that case, if the amount is not fixed, if the shares are fixed, then what you have issued is actually an equity instrument. Okay. But in another scenario, I'm saying that for 1 million that I have borrowed, I will pay in shares only. My payment is in shares. I will issue shares, but I am not fixing the number of shares. Repayment will be in shares, but amount or number of shares, or I'll write number of shares will match, or that would also look a little bit odd. Let me reframe it. Repayment of shares, amount is fixed 1 million. Shares will vary to match the amount. In this case, whatever be the case, even if I am paying in shares, even if I'm paying in shares, I'm issuing equity shares of my own company. What is the obligation on me? That those share value have to match 1 million. So I might have to give, if the share price has dropped crazy down, like it's become 5 cents or something, I might have to give literally 50 million shares for that. Or the share price has increased yearly. So I might have to give just 10,000 shares for that. But point is, I am matching the 1 million. 1 million for sure with certainty is what I'm giving. Shares can vary. So the fixed for fixed test is not met. Fixed for fixed meaning what? The amount that you've borrowed is definitely fixed. This is not changing. This is fixed. What you're returning, sorry, fixed for fixed meaning so the amount that you borrowed is fixed. What are you giving in change of that? The number of the shares, is the number of shares fixed or not fixed? If the number of shares is fixed for fixed test met, if the number of shares is fixed, then it's equity. If the number of shares are not fixed, then it's an amount which is fixed. So then test is not met, then it's a liability. Okay. Now, did anyone not understand this? Or anyone just wants me to repeat it, I will repeat it. Put it in the chat box. If you have a specific doubt, put the specific doubt. Or if you just want me to repeat, just ask me to repeat and I'll repeat it. Okay. I'll repeat it, guys. Don't worry. So, guys, what happens is that there are so many times where the organization will say that when I have to make a payment for this, I'm not going to make a payment in cash. I'm going to make a payment in my own equity share. I will issue equity shares in my organization for this. Okay. And if that is the case, then you have to look at the contract words. You have to look at the contract words. That is the contract saying. So for the first case where I'll say fixed or I'll just write shortcut. Okay. Instead of writing this big words, I'll just write shortcuts. F2F test is met. And then I'll say F2F test is not met. Two scenarios I'll show you. Okay. If the F2F test is met, fixed for fixed test is met, which means that for a dollar 1 million loan, I am saying I will give y'all 1 million equity shares. Or I will not take the same number because maybe y'all will then associate that, okay, it has to match. Let's say I'm saying for dollar 1 million, I fixed that I will give 2 million shares. This is fixed. 2 million shares are fixed. I am blocking at the contract day one only. I'm saying I will give 2 million shares. Tomorrow, the 2 million shares, today, let's say it's zero point 0.5. When I was entering into this contract, was, per share was $0.5. Is why I entered into such a contract, because today for 1 million loan, it looks like I have to pay back in 1 million only. If I have to give 2 million shares, the worth is zero point 0.5. So if I multiply, it's 1 million only. But after 2 years, when I will actually issue the shares, let's say the market price is $1. Then in that case, I'm actually repaying 2 million, $2 million actually. By issuing 2 million shares, I'm actually repaying $2 million. So if the shares are fixed, but the amount is not fixed, then the nature is equity. It's not like a liability, it's equity, because you're not saying for guarantee that you're going to make this 1 million payment. Whatever is the market price of the share, the opposite entity will enjoy that. It could be low, it could be high. What I've fixed is only the number of shares. Okay, so it's an equity. But if the F2F test is not met, which means that for a $1 million loan, I am saying that I will issue shares worth $1 million. Worth $1 million. This is fixed. The amount is fixed, but the shares are not fixed. Shares are not fixed. Shares could be 2 million shares, 3 million shares, 4 million shares to match up this 1 million liability. So if the fixed to fixed test is not met, which means you're guaranteeing the 1 million borrowed, then it's a liability. Is that understood to all those who asked me to repeat? So Adiola is asking, if you fix the amount, but then you have to pay in shares, then it's a liability. Yes, Adiola.
Worst case,
Yeah.
you're giving 2 million shares, right?
I'm giving 2 million shares. It's fixed. 2 million
Yeah.
shares.
When the market price rises to $1, you're
Hmm.
giving extra shares as a bonus. Like, should I take it as a bonus
No,
shares?
no. You're not giving extra shares. What are you giving? You're giving 2 million shares only. Contract and
Yeah,
day
2
one was
million
fixed.
shares, but worth the liability worth is 1 million. What have bought a loan is for 1 million, but
Huh.
remaining 1 million I'm giving as a bonus shares. So is it correct on my
It's not
point?
bonus shares. You can't consider it as a bonus share. It's not bonus. It's just that if the market price is high when you're going to issue these shares, then you actually ended up paying extra for 1 million worth of loan, right? It's extra amount that you have paid. But and it's not even extra amount that you paid. Actually, the transaction is no amount you're paying. You're issuing shares. Tomorrow, that party who has that shares can sell it in the market and redeem 2 million for it, right? Can sell it in the market and redeem 2 million for it. What am I issuing? I'm issuing 2 million shares. So I'm diluting my equity. What will get diluted? My share capital, share premium. That will get diluted, right? Because it will increase, no? Share capital will increase, share premium will increase on the issue of this. Share capital
Eh,
will increase by the nominal value, share premium will increase by the extra amount over the nominal value. Nominal value can be 0.25 cents here.
Yes, ma'am. Yes, ma'am. I understand. But for 1 million loan, we are giving 2 million worth of shares, right?
Yeah, yeah.
So does that mean giving extra to them? Like,
Yeah, you have. In a way, yes, you have given them something worth more for something that you got less. That hit will
yeah,
be in the premium, share premium.
then that amounts to bonus, right? Like
It's not
losing it.
bonus. Why do you say bonus? It's not bonus.
Because it's given free worth.
It's not. It's not like you want for your understanding. Maybe you can take it in that fashion. But for me, it's like I have paid in a way extra for something which is worth less. So my at then my reserves should get impacted. My reserves should
Yes,
get
ma'am.
impacted, right? So that is what it is.
Okay, ma'am. That's that out.
Yeah. Okay.
Yeah.
Okay, fine. So now I'm going to get into the examples of how we would have identified. So here it's written that company D enters into a contract that requires it to settle a contractual obligation using its own shares in an amount that equals the contractual obligation. Okay, so look at it. Company D enters into a contract that requires it to settle a contractual obligation using its own shares in an amount that equals the contractual obligations. Can you all think and tell me without reading this completely? That is this a financial equity instrument or a liability instrument? It's a liability because the amount is fixed. Amount is fixed. Shares are not fixed. Shares will vary to match the obligation. Shares will vary to match the obligation. So is the fixed for fixed test met? Is the F to F test met over here? Fixed to fixed test met or not? Is not met. This is said that it's not met, and that's why it's a liability. Okay. Now coming to the next scenario. Company Q enters into a contract to deliver 1,000 of its own equity shares to a third party in settlement of an obligation. As the number of shares is fixed in the contract to meet the obligation, okay, I don't want to read it further. In fact, from the first line only, you have to identify. Company Q enters into a contract to deliver 1,000 of its. It's mentioned 1,000. It's not said variable. It's not said to match the obligation. It's said 1,000. So from here itself, you'll tell me whether it's an equity or it's a liability. It's an equity. And F to F met or not met? F to F met or not met? Met. So yes, F to F has met. Fixed for fixed test has met. And it's an equity instrument. Okay. Now, getting into compound instruments. So sometimes you will come across scenarios, guys, where when you read the scenario, it will give you a hint that it has equity element also and it has a liability element also. And if that is the case, then you have to present it as a compound instrument. Okay, so we will understand this now. So compound instruments, remember that you could be in the exam also be given scenarios where compound instrument is there. So be able to define what a compound instrument is, that it's an instrument which will contain a financial liability component and it will contain equity component. At least you should be able to say this much, not the examples that I've provided you, but you should be able to say this much to procure that 1 mark for stating the principle. Okay. Raghavina, I'll come to it. Okay. Just give me some time now. Let me just finish the compound instruments. Yes, Ariola, example would be convertible loans. Okay. So what happens in compound instruments also? Here also things are not easy. They have kept it tricky for you. When the compound instruments has that element that it can get converted into shares, you have to see that if those shares are again fixed or variable. Because if they are fixed shares that you're going to give for this amount of loan, let's say for $1,000 loan, it's fixed that you're going to give 100 shares. This is fixed on day one. Then yes, because the fixed to fixed is met, because the F to F is met, it's equity. But let's say for a $1,000 loan, you're saying that you will give variable number of shares which will match $1,000. Then in that case, F to F is not met and this is liability only. Then it doesn't have that equity element. So even in compound instruments, because these are convertible bonds that can get converted into shares, you have to be very careful. If they can get converted into shares, look at the nature of the conversion. Is it fixed shares or is it variable shares? If it's fixed shares, then yes, equity element is present. Okay, then it is a convertible bond because equity element is present. But if it's variable shares, then the equity is not there, it's liability, then it's not a compound instrument. Okay, I'm going to do an exam style question on this, so this will get really clear for you all. Don't worry. Okay, it's a very intensive exam style scenario with all the numbers and the explanation and everything, so it will get really clear for you all. Don't worry. Now, before I end this topic, IAS 32 presentation and move to Carol question, this last treasury shares is what I will take, which is a very simple topic. Don't worry, this is very simple. And then we are moving to Carol company. Okay. So treasury shares are what? The entity, what happens is organizations, they have issued shares, 1 million shares, 2 million shares, 3 million shares, whatever, right? And number of shares. Now, understand the more the number of shares, that much the ownership is distributed. 10 million shares versus only 1 million shares, which means ownership is concentrated to few. 10 million shares, ownership is distributed to many. If I compare these two, 10 million share versus 1 million share, or let's say 10 million share versus 100 shares. 100 shares. If an entity has only issued 100 shares, which means ownership is concentrated among few. If I say 10 million shares, ownership is spread. So sometimes what entity do is that they buy back their own issued shares, and so that they can decrease the dilution of the ownership, because ownership is diluted, right? So they want to decrease the dilution of the ownership. They want to have that concentration on ownership. That's why they might buy back the treasury. They might buy back the shares. And when they buy back that shares, those shares that they have bought back will be parked in a treasury share account. It will be parked in a treasury share account. How do you do the treatment for it? I will show you all. Okay. So the entity's own equity instruments acquired by the entity itself are treasury shares. And how are they treated? They're deducted from equity because you've lowered the equity, no? You've lowered the equity. Now it's more concentrated. They are deducted from the equity. No gain or loss is recognized in profit or loss on the purchase, sale, issue, or cancellation of treasury shares. So this is not going to be a P&L movement at all. Whatever movement is going to happen directly on the balance sheet equity, not via P&L, not via P&L. Okay, because this is again transaction between owners of the organization. It's considered in that fashion. So it's not happening via P&L. It's happening directly in the equity. Okay. Now, there is an example here. On 1st January 20x5, Goldfinch Company had $100,000 one equity shares issued at $1.2 each. So that's why if you see 100,000 shares, the share capital, if it's at $1, is showing 100,000 only, because this will be 100,000 into $1. But if you see the share premium, it's showing 100,000 into 0.2, because this extra will be parked in premium always. So it's here in your balance sheet. This is how it will look: share capital, share premium. Now, on 31st December 20x5, by the year end, it reacquired 10,000 of these shares for 1.5 each. So whoever the shareholders, what it did is it made a payment of 1.5. Probably the market price is 1.5. So it purchased back from them at 1.5 for the 10,000 shares. So 10,000 shares into 1.5, 15,000. What the accounting entry must have been at this point of time? Credit bank, 15,000, and a debit impact of treasury shares, 15,000. So if you see, this is debit in nature because it's a dropping impact to your equity. Equity nature is what? Credit in nature. But if there is a account which is counter to it, which is opposite in nature to it, the impact is to drop, then it has to be opposite in sign also. So if equity is credit, treasury shares job is to drop it, so the nature is debit. So treasury shares will drop your equity. Can you see the presentation also? It's dropping my equity. Now, what if these treasury shares that you purchased are subsequently cancelled? Okay, they're going to get cancelled, meaning you don't want these shares to be like, why you're parking it in treasury? Maybe because again you want to allow the investors in the market to buy them back. You want probably the money again. So you might again circulate these shares in the market. Again, you will reissue it. Okay, sale or issue. But let's say you're decided, no, it's a complete cancellation. So what happens is when you buy it, you don't buy it as a directly cancel. First, you buy it as a treasury share. So instead of a direct cancellation, first it goes and gets parked at the treasury. Then again, if you still want to cancel, then from the treasury stage, it will completely extinguish. How will it extinguish? How it will get completely cancelled? So let's say these 10,000 treasury shares you want to cancel it out. Now, what will happen is that they are present in the share capital and share premium. If you see, I did not make this 100,000, 90,000 yet, right? So if I'm doing a cancellation, I'll have to, over here also, there is 100,000 into $1 actually. So if I'm canceling, then this 100 has to actually become 90, and share premium also has to actually become 90. So if I'm canceling share capital, share premium, they will go on the debit side. Debit side, this will have share capital, 10,000 shares that I'm canceling, and the nominal value is $1. So this is getting cancelled. Then debit share premium also getting cancelled, 10,000 into $0.2. Okay. So on the debit side, I have 10,000 cancelled. I have 2,000 cancelled. Credit to what? The treasury shares I'm cancelling. The nature of credit treasury shares was what I said. It's debit in nature. It was debit in nature. Okay. But if I'm cancelling, if I have to remove this from my books, if I want this to be removed, it should not show in my balance sheet now. It should get removed. So it was debit in nature. If I credit it, it will get removed. So I'm going to credit 15,000. Okay, I'm going to credit 15,000. Now look at my debit and credit legs. They don't match. I have a debit 12,000 and I have credit 15,000. Can you all tell me this remaining 3,000 debit? Which account would it hit? Which account would it hit? Retain earnings. So it's like a loss for me, but it will not get routed via P&L. Not get routed via P&L. Directly, this will impact my retain earnings like a loss, not via P&L, because the idea is that it's an exchange in the of the ownership. So it's between the owners is what it is understood. Such transactions, you're not taking it via P&L. You're not taking via P&L. Okay. So everyone has understood, or anyone has a doubt in this journal entry, or if anyone just wants me to repeat, I can repeat. Before I move to Carol, if anyone wants me to repeat treasury, I'll repeat. I'll repeat it. Don't worry. Okay. Treasury shares, first of all, understand that when it comes in the picture as a concept, that when you want to buy your entity's own equity shares which are circulated, the share capital, share premium that the organization is showing, what are these shares issued against which money had come? So there are share owners for this. There are share owners for this. So if I want to concentrate and have have a concentration in the shareholders, I don't want the ownership to be distributed among so many. Let's say I have 40% of the stake in the organization. I meaning let's say a parent could have stake in this organization, so it would want that 40% to become 50 or something like that. So there could be reasons why this is happening, right? You would want concentration of the ownership, so that when some shares are cancelled, this 40% would actually become 45% or the 50%. And this could also be the idea. So anyway, if the organization wants to buy its own shares back, which has been circulated, these are called treasury shares. And instead of directly doing a making a share capital 90,000 and the share premium 90,000, let's say 10,000 is what you're buying back. Instead of making share capital, share premium directly 90, what you do is you park it in another account called treasury shares. If the nature of share capital and share premium, if these two accounts are credit in nature, some account which I'm making to cancel shares from that, what would the nature of that account be? If it is there to cancel shares from those accounts, from the equity account, debit, right? So these treasury shares are debit in nature. These treasury shares are debit in nature because they're made to cancel the share capital and share premium. Okay. In order to do that, it has to have a debit impact only, then they will reduce my credit balances of 10 and 20. Okay. Now, if I'm saying that I purchase these 10,000 shares back from the shareholders and I parked it in the treasury shares, okay, what would the journal entry be at the time of buyback? I'm going to give the journal entry at the time of buyback. So this is going to be my money is going out. So first is credit bank. Money went out, so credit bank. Debit what? Treasury shares. I purchased treasury shares, so treasury shares is my debit. So this is going to be 15,000 and this is going to be a 15,000. Till here, everyone understood till the buyback part? Yeah, contra count to the normal equity shares. Till here, everyone understood. Now, I'm saying that, okay, I have made up my mind. Those treasury shares which I had bought back, I want them to completely be cancelled. So it happened in the layered form. It didn't not directly get cancelled from share capital, share premium. Now I'm saying, okay, these 10,000 shares which I've purchased from the public at large, I want it to be cancelled. I don't want to be parked in the treasury also because I don't have any future plans of reissuing or selling them again to borrow money. No, it has to get cancelled. Okay. So in that case, when I am going to do the cancellation, what is my journal entry going to be? If I'm going to cancel something from share capital, share premium, the nature is credit. But if I'm going to cancel them, then where will the share capital, share premium come? Which side? Debit side. This should be clear as a concept that if I'm canceling something from share capital and share premium, then it has to come on the directly now, not like via another account. Directly from share capital and share premium, I'm saying I'm going to cancel the effect of 10,000 shares. So from share capital, if I have to cancel 10,000 shares into $1, this will give me 10,000 debit. And from here, I will get 10,000 into zero point 0.2, 2,000 debit. So this is getting cancelled. Okay, I did debit here, cancel. So for the cancellation for debit share capital and debit share premium, did you understand what I did? At least this much. It's an incomplete entry. I have to finish it. But till this extent, did you all understand? Adiola, did you understand the why debit share capital share premium? Okay, perfect. Now, if I'm cancelling it, then the treasury shares will also not remain in existence because I'm completely cancelling share capital, share premium. So treasury shares will also not be in existence. Treasury shares nature was debit, so they will become credit. This part everyone understood that why I'm doing treasury shares credit 15,000 because I'm now doing a direct cancellation from share capital, share premium. So this line has to get eliminated. Otherwise, it will look like double time impact of removal. Okay. Now look at my debit and credit legs. Do they match? No. How much is the mismatch? Debit is right now 12,000 and credit is 15,000. So there is a shortfall of 3,000. What does this mean? This means that actually for shares worth 12,000, I had ended up paying 15,000, right? This is what it meant. So in essence, this was like a loss for me. But am I allowed to put this loss through P&L? Can I put away a debit P&L? Am I allowed to do this? Can it pass through any P&L account? Nomenclature or account naming, anything. It could be a loss account, loss on share buyback account. Ledger name could be anything. But point is, can I put any loss like this in my P&L straight away? Am I allowed to do that? No, I cannot. I cannot. So the impact is that yes, the loss booking is taking place, but not through P&L. It is directly impacting my retained earning. It is directly impacting my retained earnings. Has this cancellation entry been understood by everyone now? Yes or no? Okay, great. Adiola, did you understand the two sets of journal entry now? Okay, Adula, the first entry, you are asking why are we not directly taking the impact in share capital, share premium? Because then you're doing a permanent decrease in share capital, share premium. You might want to again sell or reissue it, right? Or you might want to cancel it. You did not come to that decision yet. So is why first you do it through treasury shares. meaning you don't directly cancel from share capital share premium. If you're very sure, maybe that could also be allowed in certain jurisdictions. Certain jurisdictions could allow take the direct impact on share capital share premium if you're sure. But let's say you're not sure. So first impact is through treasury shares, where you still might want to make a decision that, oh, you might want to reissue it, or you might want to, uh, yeah, basically reissue, or you sell it in the market and get funds again. Because if you will cancel it, then again reissue again, doing a fresh issue for share capital share premium will require a lot of paperwork, will require a lot of legal work, right? To issue new shares in the market, do you meet certain criteria or not? Maybe earlier you might, but now you are not able to meet certain criteria, you might not be able to issue again shares and pull money from the market. So once that you had that right, you might not want to lose it till you're not 100% sure, right? So you're reserving that right, is why you're parking it in treasury account. If you are 100% sure you're going to cancel it and you would not want money against it in the future, cancel those treasury shares and cancel the share capital share premium as well. Idealize this, understood now? Okay, great. So this was the last topic that I wanted to do from IAS 32, guys. Now I'm going to take you back to the Carol question. Okay, reading the background. Why is this pen not working? Carol Company operates in the leisure and recreation sector. It prepares financial statements in accordance with IFRS accounting standards. Its financial year end is the 31st December. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Convertible instruments. Provides information about convertible instruments which Carol might issue. Okay, so you have convertible instruments. Provides information about convertible instruments which Carol might issue. We just learned about convertible instrument, that it has to have certain criteria, then it's a convertible instrument, and it's going to have so this component, A component and B component. I don't want to say the names because when I'm drafting the answers, I want everyone to participate. And in which case it meets the equity test, in which case it does not. Okay, we'll get into all that. Second is KPI, key performance indicators. Provides information about KPI, key performance indicators, calculated for the year ended 31st December 20x7. Further, the information should be used to answer the question requirements within your chosen response options. Now, before I read this exhibit 1, I will go to the requirement. Using exhibit 1 and in accordance with IFRS accounting standards, explain why Carol Company should recognize the convertible loan note as liability. They already told us that why it should recognize as a liability, which means we don't have to crack our brains into thinking that is convertible loan note a liability or an equity instrument. No, they are saying it's liability. Why? You have to prove why. Okay. And the convertible preference shares as a compound instrument. So this again, the second thing, don't break your head into thinking, oh, preference shares is liability, equity or compound. They are saying it's compound, prove why it's compound. Your head breaking should go in that direction. And explain with calculations the amounts which Carol should recognize in the financial statements for the year ended 31st December 20x8 in relation to both instruments. Okay, very good. So there is giving reasoning of why it's liability, why it's compound, and then giving the numbers for that particular year. So what I'll do is I'll take a worksheet now. And this is Carol Company. This is from my September, December 2025. Okay, requirement A. So I'm going to pull this question so that I can easily identify what is the exact requirement. And this is worth a 11 mark. Okay, so what it wants is convertible loan note as liability is what I have to prove, one thing. Then I have to prove convertible preference share as compound instruments. If I break down my requirement, the 11 mark that is there for this, I will be able to easily fetch. If I don't break the requirement, it will get really difficult. And with calculations, amount it should recognize in the financial statement. So measurement of convertible, and then measurement of convertible preference. Four things basically is what I've identified. Okay. For me, then getting that 11 marks becomes really easy. That okay, from the four things I have to get the 11 marks. From these four things, I have to get the 11 mark. Okay. Now coming to my question, exhibit rather. Now, 1 minute. Convertible loan notes, I have to prove that it's a liability. So let's get into it. Okay, by the way, before I get into convertible loan notes as a liability, can you all tell me that what were the keywords in the definition for liability that classified that okay, so and so instrument can be a liability? What should be there for instrument to be classified as a liability? Contractual obligation to deliver cash or another financial instrument. Great. Okay, so let's look if that's present or not. Now, coming to convertible instruments, the management of Carol is considering issuing one of the two financial instruments. So they're considering one of the two options, one of the two financial instruments to raise 5 million. They want to raise 5 million only. They have two options. Okay. The proceeds would be used to finance the company's expansion. When they issue the either of the financial instruments, they're going to get 5 million, which they will use to expand the company. But they have to always think that okay, which would form the better option, because how would the company's performance look like? How would the KPI look like? At the management position, so many of the bonuses of the management is dependent on their KPIs, right? The KPIs are like for management, like controller, the controllers, the senior managers, the CFOs, based on profit figures. Profit should be so much, or should increase by 3% compared to previous year, or by 5%. These could be the KPIs. The gearing should be so and so. You should not, gearing should not exceed this month. These could be the KPIs, right? So if they have to issue a financial instrument, let's say someone like a controller who's in a position to, do the decision making, will make a wise decision that, okay, if I use option A, how would my results look like? How would my profit look like? How would my PBT look like? Because my PBT my KPI or my bonus is dependent on the PBT. How would the gearing look like? Because my bonus is dependent on it. They would have to make these decisions. Okay. So anyway, the issue would take place on 1st January 20x8. Option one. What option one he has? $5 million convertible loan notes. So you have $5 million convertible loan notes. The other is a $5 million convertible preference shares. Now, we just learned that just by the nomenclature or by the name, you cannot say this is equity or this is liability or this is compound instrument or this is actually the word compound instrument, but is actually a liability. You can't say that, right? You have to read the terms of it. So we'll start reading the terms of it now. The loan note would each have a par value of $1,000. They would pay a coupon interest of 9% each year in arrears and be redeemable at par at the option of the holder 3 years after issue. Alternatively, the holder may choose to convert the loan notes at any time during the 3-year term into variable number of ordinary shares. There are two sentences that I have identified in this paragraph, which already very clearly helps me identify that what it is. So can you all tell me first what it is from the first paragraph that we have read? What instrument is this? Equity or liability or compound? Equity, liability, or compound? It's liability. And in fact, even they told us. Remember, I told you very clearly that they told us it's liability. We have to justify. Now tell me the two keywords which helped you justify that this is a liability. What are the two keywords? That the right is with the holder And the shares are that you're going to give a variable number of shares, which means the F2F criteria is met or not met. F2F criteria is met or not met? Not met. Not met. So if you try to do everything together, it can be intimidating. But yes, if you try to go in a breakup manner, like break the requirement, go one by one, things will appear to be very easy. Okay. So convertible loan notes as a liability, I have to get 11 mark. I already have my subheadings that from where I'm going to fetch my marks. Quickly, when I read the exhibit, I'm going to do my framework, that I'm going to give the definition of liability, that it's a contractual obligation, right? So I'm right now, I'm just doing the framework. I'm not drafting the whole answer. That it was a contractual obligation for cash or financial asset. Okay, this is one sentence. If you want, I'll just write little more fuller words. For cash or financial asset. This was one point, the definition part or the state part of the standard, the S, the state part. Then I'm applying to the scenario. What helped me identify that it's a liability? That holder has the right. Okay. The F2F test not met. Not met. Variable shares. So conclusion is what? That it's a liability. So if this is my structure. If you want, I can write over here also that this was like the state part. It's not required for the you to in the exam to write the state. I'm just writing this for your ease. That how I did the framework application. This is apply, apply, apply. Then I did a conclusion. You can do apply, apply, apply also and get the complete marks. No need to state also. No problem. That will also work. If you have enough points in application, that can work. But sometimes if there are a lot of marks, then you don't have a lot of marks, that maximum marks that you can get complete marks from application. 1 or 2 marks, yes, you'll have to state the accounting standard, something from there, and then get that 1, 2 mark. Okay. Then I am not sitting and drafting the whole answer. I'm just discussing the points. Then I will draft. Don't worry. Then I will draft. Yes, I will share the PPT also. Don't worry. Now, moving to option 2. Sorry, I have not read one more line. I'll read the one more line. The terms of conversion would result in each 1,000 loan note being exchanged for a number of ordinary shares whose total value, fair value, on the conversion date is equal to $1,000. Okay. So even before I could read this statement, here when they said variable, I had already made my conclusion. This also just adds to it. This just adds to my answer. Okay, so Raghavina, we are doing the convertible loan note slide right now. We are doing this slide. Sorry, compound instruments, where they are telling us that if you are going to, sorry, 1 second, not compound, 1 minute, 1 minute. Convertible instruments. Yeah, you're into compound instruments where if it may seem like, okay, if there is a financial liability and equity component, but if there are variable number of shares, then it's not actually compound, it's a liability instrument only. Okay, it's a liability instrument only. It's this slide. Okay, now I'm going to go to option 2 now, guys. Option 2, where they're saying 5 million convertible preference shares are option 2 is to issue 5 million preference shares. The preference shares would be issued at par. Carol would have an obligation to pay compulsory annual dividends at 9% each in arrears. Before I read anything, this one sentence itself means what? This one sentence where the obligation to pay compulsory annual dividend comes. What does this one sentence mean? Yes, that there is a liability element present for sure. The entire thing could be a liability instrument only. But let's say if the entire thing is not liability instrument, then at least liability component is 100% present. Okay, then 3 years after issue, the shares would be mandatorily convertible into ordinary shares at a rate of 1 ordinary share for each 5 preference shares. Look at this. The shares would be mandatorily convertible into ordinary shares at a rate of 1 ordinary share for each 5 preference shares. This, when you see that you are going to make a payment in the form of shares, in the form of your own entity shares, but they will be 5 preference shares for one ordinary share. That's fixed. Then is this equity or liability? Has the F2F met? Has the fixed to fixed test met? Has F2F met? Yes, it's met. For the 5 million that you have borrowed, you're specifically going to give fixed number of 5 preference shares for each ordinary share that you've borrowed. So it's met. And because it's met, this is what? This part is what? What component is this part? Equity. Okay. So because now it has equity and liability, both components, is it now safe to say that this is a compound instrument because it has liability and equity component both? Is it safe to say that it's a compound instrument? Yes. Okay. So now quickly drafting the skeleton only, then I'll do the full answer also. I'll do both, don't worry. Why I'm doing the skeleton is only so that you all understand that when you're reading a scenario, it's so easy to get the points. For points, we panic. But actually, it's very easy to get the points. Convertible preference shares is a compound instrument. So let's first do the definition. What is a compound instrument? A compound instrument would be something which will have both equity and liability component. Okay, this is something like one thing. Second, I will prove that, okay, what liability component is present and what equity component. The liability component is easy for me to prove. The mandatory dividends. Okay. The equity component is what? Fixed for fixed. Met. Shares are fixed. So conclusion is it's a compound instrument. So if you want, this is actually my state part. This is my apply part. This is my apply, and conclude. So everyone is comfortable. Everyone is comfortable the way I'm going to take this now and explain it in a full way. Okay. So I'll start drafting the answer. Okay. I'll get into the measurement later. First, I'll finish this. I'll draft this answer. This I'm just doing for demonstration purpose for your ease, so that when you have this, picking points is so much easy. Okay. If I start drafting the whole answer, paragraph, it just gets too intimidating. I know. So this is just to show you all. It's actually just pulling simple points, which is easy. Okay. So convertible loan notes as liability. I'm doing state that what is a liability. Okay. So as per IFRS, just to be quick, I'm not even getting into stating the standard that is as per IAS 32, because as such, no marks for that. So avoid it. As per IFRS, uh, financial liability. Why the bold is not going? Consists of an obligation to pay cash. You can stop here. Instead of writing to pay cash and financial asset, you can avoid that. Why? Because your relevant to scenario is right now cash, so you can even just write this much and stop. Or you can write. Or financial asset. It's up to you. You could have stopped till cash also. Okay. Then apply. In this case, the holder of the instrument has the right to demand. Just let me get back to the scenario. demand, right to demand payment or convert it into which kind of shares? Into ordinary shares. Okay. However, the shares, if chosen, the share of shares as redemption option, if chosen, are fixed against the, sorry, are not fixed rather, are not fixed because F2F not met, no? So are not fixed and has to be, I remember the last line, right? Equal to the $1,000 loan note. Therefore, fixed fixed for fixed criteria has not been met, and therefore this is not a equity but a financial liability. Okay. Now you'll want I can keep this, or you'll want I can delete it. I just wanted to use it for demonstration purposes. Should I keep or should I delete? Because I don't want unnecessary the answers to look long. So I just don't want you all to do in the exam that, oh, you'll think that this is an obligation to present it in this fashion also. Okay, so I'll just keep it. Okay. So anyway, one, I have stated it that it's an obligation to pay cash. So this is a one full mark point because I'm stating one full whole point. And what does IFRS tell on this, right? That it's an obligation to pay cash or financial asset. For a liability, the definition, what it is, it's a full 1 point. Then I'm applying to the scenario. Okay. In this case, the holder of the instrument has the right to demand payment or convert into ordinary shares. I doubt that the marker will be able to give me a mark because if you see, I'm not able to add anything new here. It's pretty much a point pulled from scenario, which helps me do the application. But independently, this sentence is not something revealing, you know, or worthy of attracting 1 mark. Okay, it's not worthy of attracting 1 mark. However, the shares as redemption option is chosen or not fixed and has an equal and has to, okay. However, the shares as redemption option is chosen are not fixed and has to be equal to the $1,000 loan note. So this is yes worthy of 1 mark. Therefore, fixed for fixed criteria has not been met, and therefore this is not an equity but a financial line. Okay, professional marks, yes. Wherever for professional marks will be given for relevance. So yes, if your answer is relevant, then yeah, the relevance marks will come in picture. But this particular requirement, I go. This was for Exhibit C, not for Exhibit A, which I'm catering right now. Okay, the professional marks were not in this case for requirement A. Now coming to convertible preference shares as a compound instrument. Okay, so I'll just quickly give definition of what a compound instrument is as per the standard. The compound instrument consists of both equity and liability component. At this point, I know that if I would have corrected some scripts, some students would have gone into more detail and told me what is an equity element. It is the residual after making payment of all liabilities, whatever remains from the asset, then the liability. Again, someone would have ended up repeating this point, but not required really because you'll have to draw a line. It's worth 11 mark. You already have to talk on 4 topics. Okay. So not to get into unnecessary detail, not to get into unnecessary detail. Also remember, not a lot of marks will be there for stating. So if I have like here now 2 subtopics to explain why convertible is a liability and why preference is a compound instrument. And then there is measurement also. So then understand that not more than three marks or four marks would be all right, not more than that. So out of that three, they will not give two marks for stating. 1 mark could be capped for stating a principle, not 2 marks. Rest all marks should come from application. So draw a line. How much are you going to state? Draw a line to how much you're going to state and get that mark. Okay. Now coming to the next, what component over here was liability, right? So as the preference shares had has mandatory dividend payment attached with it, it meets the criteria of liability because of the obligation to pay cash. Whole point. Worthy easily of full 1 mark. Okay. Then from the equity perspective, what point was equity? The instrument will be mandatorily converted into shares where the shares are fixed. If I may go back to the scenario, fixed 1 ordinary share for each 5 preference share, where the shares are fixed as 5 ordinary shares, or sorry, other way around, right? Yeah, where the shares are fixed as one, sorry. Yeah, 1 ordinary share for 5 preference shares. This meets the fixed to fixed test. Therefore, this is an equity component. So this is worth full 1 mark because I'm giving one definition which is directly relevant for the scenario, the mandatory and the equity point. Okay. Now remaining marks, which is actually now a 6 mark, not six rather 5 mark, right? Three, I got 6 marks. So 5 marks I have to get from measurement, which I'll get now. So if the measurement of convertible loan notes, if I've already proved that the convertible loan notes are financial liability. So financial liability, how are they initially measured? Do you all recall how are they initially measured? And then how are they subsequently measured? Quickly, how are they initially measured? How are they subsequently measured? I did mention, right, Sana, the 12% annual dividend is actually as a mandatory. You want, you can write this as 12% dividend. Mandatory 12% dividend payment. I added it. Yes, fair value. So initial is at your fair value. So the loan notes will initially be measured at fair value of, sorry, how much is the fair value? You know it's 5 million, right? 5 million at 5. In total, it's $5 million. Subsequently, You know that subsequently, how do you have that bought for amortized table? Bought forward plus, can you tell me what comes after bought forward? Effective minus coupon will give you carry forward. So you want, you can draw this table so that you can explain it. Okay. So I'm going to write subsequently, the 5 million will increase by the effective rate dash. I don't know what. I'm going to come to the scenario and read the effective rate. They would pay a coupon of 9% each year annually, and there's no effective rate given. So if there's no effective rate given, then the coupon and effective would be same. So effective rate 9%, which will amount to, so 9% on the 5 million will amount to how much? So you want, I can quickly show you the table here. 5 million here, subsequent here. So I do a bought forward, I do a effective, I do a coupon, then I do a carry forward. This is how you have learned in the FR bought forward syllabus if you have watched my previous videos. So effective is 9%. In this case, effective and coupon will become the same, because if there's no premium, no discount, then effective and coupon are same. And my carry forward will also become a 5 million. Okay. So subsequently, the 5 million will increase by the effective rate 9%, which will amount to $415,000. This will be recorded as finance cost in the financing of the PN. The liability will then drop by the year end due to the payment of coupon, $450,000, and the liability by the year end will become 5 million again. They wanted the measure at 31st December, I think 20x8. To be more precise, they wanted the measurements at 31st December 20x8. So 31st December 20x8 will become 5 PN again. Not market rate. You will not call it market rate because you decided it's a liability, right? If it was a compound instrument, then market rate would come in picture. But now that you've decided it's a liability, it's effective and coupon. Okay, so till here, I hope everyone is clear. Till here, I hope this is just for support purposes. No need to probably show it here. The loan notes will initially be measured at fair value. This will attract 1 mark. Then the 5 million will increase by the effective rate, which will amount to 450. This will be recorded as a, so the measurement plus treatment, ideally, I feel like would have attracted a 1 mark here. Will then drop by the coupon, and by the year end, it will become 5 million again. Now, coming to the measurement of convertible preference shares. Still here, everyone is sound before I move to the next part. This was really easy. It's just the initial measurement, subsequent was effective coupon being the same. I just explained it in words. Nothing, no rocket science. No, Adiola, don't talk about statement of cash because that would become too much of talking, meaning additional talking. You have to get fetch marks from talking about the presentation in the P&L and balance sheet. Cash flows is not something you will touch. Okay, not required. Okay, so if no one has a doubt, I'm going to move to the measurement of convertible preference shares. So convertible preference shares, if you have already identified it is a convertible bond, can you all tell me initially for a convertible bond, what are the two elements that you identify or two components? If I have to show you on Excel for my option 2, initial measurement is going to have two things. What are the two things? Can you all put in the chat box quickly? Equity and liability. Yes, you have to measure your equity and liability both. And subsequently, for the liability, there'll be a change. It will keep changing. You'll have bought forward, you will have market rate, you will have the coupon, it will drop because of the coupon rate, and then you will have carry forward. So your liability will change, but your equity remains the same. Your equity remains the same. So whatever equity you first measured will remain as is. For subsequent liability remeasurement will be required. Now the initial measurement of liability. Do you all recall how do you do the initial measurement of liability? The initial measurement of liability, how do you do it? First, I will do the liability, then I will do the equity. The initial measurement of liability, how do you do it? All the cash flows you will bring to present value. All the cash flows you will bring to present value. Yes. Now, you will have the years, you will have the cash flows, you will have the discount rate or the discount factor, and then you will bring it to present value. So this is my working sheet. You will have Excel provided. So you will do the workings here. Now, for how many years was this going to be there? 3 years after issue, the share would be mandatorily converted into ordinary shares. 3 years. So for 3 years. What are the cash flows that are going to be there? The cash flows are going to be on the 5 million. Will you use 9% or will you use 12% for the cash flows? Will it be 9% or will it be 12%? The obligation to pay compulsory annual dividends at 9%. Non-convertible bonds have a 12% similar rate. Yeah, 9%. So 9% of 5,000. Discount factor. When I discount it, when I use the discount factor, for that, should I use 9% or 12%? 9% or 12%. For that, I should use 12%. Absolutely correct. And it's an arrear. So the first one itself will be discounted. First year itself will get discounted. The power of 2. The power of 3. Now just think and tell me. It's logical that I'm trying to ask you. You might be able to give the correct answer, guys. You might not be able to give the correct answer. The cash flows I've strictly taken for my liability measurement as 450, which are the coupon payments. I did not take the face value of the loan, 450 plus 5,000 in the third year right now. Should I add 5,000 or 5 million the face value of the loan for the third year or no? Should I bring that 5 million face value to present value also for my liability measurement? Yes or no? Mohammed Abbas is saying yes. Adiola is saying yes. Usman is saying yes. Roshni is saying no. Roshni, why no? What is the reason? Abdul is saying yes. Okay. Understand, guys. What I'm trying to right now measure is my liability, initial liability element. Okay. This working that I'm doing right now is to find my initial liability element. The question said that it was mandatorily going to be converted into equity shares. If it was mandatorily be going to convert it into equity shares, is my third year cash flow 5 million then? Am I paying 5 million? Is my third year cash flow 5 million? Am I paying 5 million? If it's going to be mandatorily converted into equity shares, then am I actually making a redemption of 5 million? Am I going to ever pay 5 million? No. So that's not my cash flow. So I should not be taking it. Okay. So what I have brought to present value are only my proper cash flows only, which are the coupon payments, which is coming to 1080.82. So this is my liability measurement. My equity measurement will be the difference from the proceeds. Proceeds are 5 million less liability, which is 3919. This is my equity element. So this is different compared to the FR sum, where FR sum you always saw that there was option for whether you're going to pay in cash or equity, right? So if it was optional, the third year you did show the 5 million cash outflow. But here it's not optional, it's mandatory equity. So for the first time, you're not taking that whole face value. And because of that, the equity is now higher than liability. First time you got a split like this. Okay. Anyway, point is you got your split. So for my bought forward, I have to take this liability and unwind it on the market rate, which is 12% minus the coupon rate, which is the 450. Okay. So this is how I would have done my calculation because they wanted the calculation only for the first year and 31st December 20x8. So for the year end 31st December 20x8, my beginning of the year initial measurement is this and subsequent is this. This is what I have to explain in words. Now, anyone has a doubt here before I start explaining this in words? Sana, you're asking, sorry, but why are we taking 12% for discount factor? So you have to go watch my FR brought forward syllabus. If you're part of my regular batch or recent batch, you will have access to my FR brought forward syllabus where I have explained in detail that why for a convertible bond you will use the 12% to bring it to present value because that 12% is the coupon for a regular bond. And in any country, normally a regular bond, the bonds would be issued by the government. Those bonds, the percentage that is attached is normally it's considered that it's just there to beat the inflation. So that's an indication of an inflation rate is why to bring it to present value, you're using the price of a regular bond. Priscilla is asking, how did I get the 3919? What is my loan note proceeds 5 million? What is my loan note proceeds 5 million? So 5 million less 1080, the liability element. If you'll watch the FR brought forward knowledge, then only you all will be able to relate specifically the convertible bonds. Please watch. If you're struggling with what I did right now, I have just done the application, the knowledge that you should be having right now. I did not explain in detail why this, why this, why this. In my lecture, I've explained why the cash flow column, why the discount factor, why present value, why are you taking the coupon, why are you taking the effective at what, everything in detail is explained. Right now, I'm just doing the application of that knowledge. I'm not getting into the whys. I'm just getting into the application of that knowledge. Adiola, do not discount the 5,000 in year three because 5,000 is not even a cash flow of year three. What I am discounting is now I'm taking 5,000 into 9%. This is the interest rate that I am, coupon interest that I am discounting and bringing to present value. 5 million itself, I am not bringing it to present value because 5 million is not my cash flow. 5 million is not my cash outflow. That's why. Anyone else? Any other doubt? Okay, great. So now this I will explain. Okay, this I will explain. So I'm going to go here. Measurement of convertible preference. Convertible preference shares are not convertible because these are compound instruments already proven, right? So compound instruments on day one should be split into equity and liability component. Liability component will be the present value of the dividend payments. In this case, dividend payments. Otherwise, you call it coupon payment. In this scenario, it's called dividend payment. So that's why I'm saying dividend of the mandatory. I would use the word mandatory of the mandatory dividend payments brought to present value using the market rate 12%, which is the coupon. I'm just not getting into too much details because I know I'll reach max. It's a full point to write, which is the coupon rate for an ordinary bond. It's a full point to write, which is nice. but I know that there is so much to talk about and I'll reach max. So I'm not getting into a lot of details right now. Okay. Brought to present value using the market rate to us. Therefore, $450,000 brought to present value is 1.080 million, and give the reference of the working. So this was my working one. This is my working two. Therefore, 450 brought to present value is 1080 million. The equity element will be what remains from the proceeds after removing the liability element, which is 3919, right? So 3.919 million can walk into reference. The equity element will remain unchanged. However, the liability element will increase due to the unwinding and drop due to dividend payment, and will have a year end liability of 0.760 million. Well, want you can get into the detail of 1.129 can be recorded in the finance cost as a finance cost, but I feel like I've already touched max, so I don't want to get into the detail. Okay, so I'm going to give you the mark distribution. 1 mark. This is a whole point. This itself is a whole point. This is a whole point, but what I can see is that you've already touched max, so no point. Yeah, market rate is stated in the question. Yeah. Okay, so this is how I've got my 11 mark. And I think if you would have tried to attack this without having a skeleton for you, it would have become really difficult. So best was to, sketch out the skeleton and then proceed. Okay. What happened? Did I just by mistakenly delete the convertible bond points? Compound instrument? Maybe I did. Okay, I'll recreate for you, no problem. We'll have both equity and liability. So what was the liability side? The mandatory dividend payment. Um, Equity was fixed for fixed met ratios. But these were the points. What to write? State, apply, apply, apply. Yeah, last paragraph I can re-explain. What I'm trying to explain is the liability future measurement, okay, subsequent measurement. The equity element I said will remain unchanged subsequently. If you want, I'll form a fuller sentence subsequently. However, the liability element will increase due to the unwinding. Unwinding of what you know that you've brought it to present value. What was this multiplied by discount factor? You brought these cash flows to present value. So if you brought this to present value, the 1080, it will get unwinded. So when you divide it with the 1.12%, now you will multiply it with 1.12%. So this is the unwinding. And it will drop because of the coupon payment or whatever, in this case, dividend payment. So you will have a carry forward value of 760,000. This is what it means. Is it okay? you want, you can.
Ma'am,
Yeah.
convertible loan notes is different from convertible bonds.
No, nomenclature wise, they are same, but treatment will depend exactly on what is written inside that.
Uh, I got confused between loan notes. We don't classify between equity and liability, right?
Normally, yeah, just loan notes. If it's mentioned and not convertible, then you don't
Uh,
classify between equity and liability. Just loan notes.
this is
But if it's
convertible loan
convertible,
notes.
but if it's convertible, then you can classify between equity and liability depending upon if the so if there is there if it's mentioned convertible, just convertible itself will not mean that okay, you will do a equity and liability, you will have equity and liability elements and you will do a compound instrument treatment. No, just because convertible is mentioned, don't. If convertible is mentioned, check that it has equity component and liability component both or not. Did it have mandatory dividend payment or did it have mandatory face value payment of the fine 5 million? Did it have something like that? If that,
Uh,
then yes, at least the liability element is met. For equity element, did you have to make a payment in shares where the shares number was fixed? You had the option for share payment, but the share number was not fixed. Amount was fixed. So
yes.
because there's nothing of equity nature, this was not a compound instrument.
Okay,
It
ma'am.
was
Thank
just
you.
a liability. No problem.
Okay, ma'am. Thank you.
No problem. Okay, so I've come to an end to this part of it. Now I'm going to get into the KPI. Just the KPI is too small and too easy. It's not getting into depth. KPI is not getting into depth. It's not like so much detailed. Okay, I'm finishing it. 10 minutes and we're done.
But I have
Eight, nine.
some doubt here. Sorry for disturbance.
No problem. Tell me.
So we said that if the loan is to be redeemed in variable number of shares, it is a liability. So I don't have any doubt here. But when we redeem the loan in the future, it could be in 5 years or 2 years later. So we are not going to pay in cash. So that time we kept this balance in liability, not share. So is there any journal entry that time to convert from the loan or liability to share equity?
Yeah. So if you have a loan recorded in your books and at the time of redemption, if you're going to issue shares, right? So you will
Yeah.
remove the loan from your books. Your loan nature is what? Credit in nature. So you will have credit,
Yes.
right? Now, when you're
Mhm.
going to pay back that loan in the form of shares, so the loan has to get out from your books, right? It has to get
Yes.
cleared off. So
Yes.
loan which is credit in nature will become debit, correct?
David, yes. Yes.
In return of that, what are you issuing? You're issuing shares. So
Yes.
shares nature, when you issue it, share capital and share premium will get hit. Nominal will sit in share capital and extra will sit in share premium, right?
Okay.
So
In credit
credit
side.
leg will be share capital and share premium.
Yeah. Thank you.
Okay,
Clear.
no problem.
Okay.
Okay, no problem. Okay, so we'll go to the B1, which is just 10 minutes. I know it's a heavy topic, but what happened right now? But this is very light. This is very light, trust me. Okay. Using Exhibit 2 and your answer to Part A, discuss the impact which each convertible instrument would have on gearing and adjusted profit before income taxes in the annual report for the year ended 31st December 20x8. So they want the impact of both the options on gearing and on adjusted. Don't worry. Sounds like too much to do, but just see the requirement. It's just 5 mark. Sorry. Okay. So what are they asking? They're asking impact on gearing. They're asking impact on adjusted profit before income taxes. Okay, then in gearing, they want impact from both option 1 and option 2. Same goes for adjusted profit before income taxes. They will want the impact from both. So once I have the requirements clear, I know I'll not forget anything, and that 5 mark fetching would become mostly a piece of cake. Okay. So the first option where we end up issuing financial liability. Here, this is a financial liability. So if you're going to issue financial liability without even reading the exhibit, there is some exhibit out there. But just to keep things simple, when you issue a financial liability, will the gearing increase or decrease? You're increasing the financial liability without increasing the equity. So gearing will increase. So this is logical, even without reading the exhibit. But now let's read the exhibit. KPI. Carol calculated the following KPI for the year ended 31st December 2007. Gearing, calculated as debt upon debt plus equity, was 32%, which was on a year-on-year reduction of 3%. So it was decreasing, okay? A year-on-year trend. Adjusted profit before income taxes for the year ended 31st December 2007, for the previous year they're giving all this, was 17.6 million, representing a 7% increase year-on-year. Okay. Gearing was decreasing 3% by year-on-year and profit was increasing 7% year-on-year. Okay. Adjustments were made for gains and losses arising on fair value measurements, as well as non-recurring items, such as asset impairments and restructuring costs. Why are they talking about adjustments here? Because they use the word adjusted profit before income taxes. So they're just justifying that. What do they mean by adjusted? What have they adjusted for? They've adjusted for any fair value adjustment, for non-recurring items, for impairments and restructuring, because these are one-off items. That's why they remove the impact. Okay, this is their justification. Carol refers to both of these KPIs in press release and investor presentation. Okay. Carol is expecting minimal changes to its financial performance and financial position in the year ended 31st December 2008, except for the impact of issuing either convertible loan notes or convertible preference shares. So it wants to understand the impact, nothing. So if it had a gearing of 32% because of debt upon debt plus equity, this first option is definitely going to increase it. The first option, which is issue of financial liability, without any increase in equity element, will definitely increase the gearing. Okay, simple. If I am issuing financial liability, you all know that it had an impact of interest element also, which is sitting in finance cost. Will that finance cost impact your adjusted profit before income taxes? Will it drop? Will it have any impact? Yes or no? The first option, will it have any impact on the adjusted PBIT? Will it drop my profit before income taxes? Yes or no? Will it drop? Yes or no? Yes, it will. Yes, it will. Okay. So the first option will lead to a finance cost of 450,000, if I'm not wrong, $450,000, which will drop the adjusted profit before income taxes. So this option also I wrote. This impact also I wrote. Now the second option, where it's compound, so it has both debt and equity. Now it has both debt and equity, but I want you all to come here and see the ratio of debt and equity. Sorry, it's in my Excel actually. Here I have put the ratio of my debt and equity. My debt element from this is only 1080, 1.1 million almost, and the equity element is almost touching 4 million. So when I issue this compound instrument, do you think the gearing will improve or not improve? If I issue this compound instrument, will the gearing improve or not improve? Looking at this ratio, yes, it will improve because liability is increasing by a small proportion, equity is increasing by a higher, right? So it will improve. You want, you can check also the impact on gearing of option 2, working 3. So it's debt upon debt plus equity, right? So my debt is 1080 divided by 1080 plus the equity element is 3919. 21.6. So this is 21.6. And right now, for this compound instrument, the debt to equity, debt upon debt plus equity ratio is 21 something. But if you see in the question, the entity had 32. So if a gearing of 21 comes while there is a 32, the average will now drop. The 32 will now drop. Okay, so option 2 as the compound instrument has both equity and liability element at day one, with equity increase being higher than the debt, will lead to a drop in equity. Will lead to a drop in equity. We can see the ratio, the gearing ratio for this compound instrument is 21%, which will definitely drop to 33% almost. 32% due to averaging. Okay, on day one. Y'all can go into more detail and explain the year-end impact also, because by year-end, what will happen? That the equity will remain same, but the liability will drop further. Because liability, if you remember the chart, I'll show you. The liability at day one is 1080. This is what you're taking. But by the end, year-end, it's coming to 760. So if you want this measurement I did for initial, we can also do year-end measurement. So year-end measurement will become 760.5 divided by 760.5 plus 3919. But I will have this interest which will drop my retained earnings. So I will write negative dropping by 129.69. So this will even lead to a even reduced gearing by year end. 16.7. By the year end, the gearing will even reduce further to 16.7%. I'll give reference working for. As there is drop in the liability by year end. So this is easy. This I was just supposed to get the 5 mark here. And I've already, okay, 1, 2, 3, 4. Now for the, sorry, I think in the, yeah, no, this is right. This is right. I'll explain, don't worry, I'll re-explain this. Now for the option 2, how it is impacting the adjusted profit before income taxes, will it have any dropping impact? Yes or no? Is there any expense recording in the P&L? The option 2, does it have any expense recording in the P&L? Will it impact my adjusted profit before income taxes? Yes or no? If yes, will it drop or increase? Will it drop my profit before income taxes or will it increase? It will drop. There will be a finance cost of 129. Sorry. $, which will drop the adjusted PBT. So this is also a 1. Is everyone clear? Anyone has a specific doubt now? Yes, what is the doubt?
Yes, madam, I have a doubt on
Okay.
on how, okay, I was just trying to refer to the cheat sheets on how we did those calculations up on the convertible. I think the only thing maybe I saw on the cheat sheets was the convertible bond, but I didn't see the other calculation on how like you could come up towards that.
Do you mean the
I don't know if you
calculation,
got
this
my question.
calculation that I have done? You're saying that how to come up to that?
Yeah. Oh, no, but the previous part on the
You mean
not on the KPIs, but
these calculations?
yes, this one option 2, I got it because I think it was a convertible bond, so that one is okay. But on the first working is where I was like, the
This
first
one you're
working is this
struggling?
one. Yeah, I'm like, which one is it in terms of
This
the
is
cheat sheet? Like, is
okay.
it?
I'll tell you in cheat sheets. In cheat sheets, you have financial liabilities, correct? Financial liabilities,
Yes.
you have to just record it using the amortized cost table, right? Just the amortized cost table. Bought forward, effective, coupon, carry forward. Financial liability, the ordinary loan notes. The ordinary loan notes. How do you give the treatment for that? It's just that.
Also, for working one is it's a financial asset.
It's a liability, no?
Or it's a financial liability, and it's
Yeah.
treated as a loan note. Yeah.
Yes.
So, but initial here I have loan proceeds minus transaction costs
Yeah,
as
that's right.
how we treat this.
Yeah, that's right. So the fair value here would be considered as loan proceeds minus transaction, but there are no transaction costs. That's why this itself.
Oh, okay.
Okay.
Okay. All right. Thank you.
All right. So guys, now all those who told me that did not understand this working, right, that I did for gearing. See, what is gearing? Debt upon debt plus equity. What for my this specific compound instrument, what was my liability and equity split on day one? My liability was 1080, so I took it as debt. My equity was 3919. So as when I have to take debt upon debt plus equity, so for debt I took 1080 and this 3919. So this is giving a ratio of 21%. Simple. It's all up here, right? The linking is all up here. At the year end, my liability becomes 760. So my ratio changes by the year end. 760 minus the 1291. Why I'm doing? Because equity 3919 will have a finance cost booking of 129. It will drop. So that's why. Okay. In fact, these calculations will carry more marks, but the marker will not be able to mark you so much. So many places he will also end up writing max, max, max. Okay. But anyway, for explanation, if you have valid explanation, even if the figures are incorrect, because basis on the own figure rule, these explanations will have solid marks, full marks. If the explanation is making sense, if like the figures are here and there because of some calculation error, still like I'm saying, own figure rule, full marks. Okay? Own figure rule, you will get full marks. Okay, guys, I'll have to take a hard stop here now. It's a little late. So we'll continue now in the revision week, our practice session 7, the webinar and the grand revision sessions. Okay. We'll be cracking a 100-mark paper in the webinar. Then there is a 100-mark mock. There we'll be cracking another 100-mark paper. There's a 50-mark mock. We'll be cracking a 50-mark paper. So 250 marks we're going to crack. Yeah, I'll try my best that we have the plan. Yeah, all you. Thank you, everyone. Have a good day. Bye-bye. Yeah, I'm sharing the sheets. Okay, I'm sharing the sheets. Yeah, I'm sharing the Excel and the sheets both.